Okay. Okay, third time's the charm. I am just having tons of technical issues today. I'm using the software, Open Broadcasting software, which is just really buggy, and my microphone hotkey wasn't working properly, but I've got that all squared away, and I'm going to be starting over now for the second time. But so today I will be reading through some of this book, Picking Growth Stocks by Rowe Price Jr. I think this is a really interesting book. The whole kind of thesis of the book is that productive industrial companies have life cycles similar to that of a person, and that an examination of those life cycles can be used to build a solid investment strategy. So that's what we'll be examining today. It was originally published as a series of journal articles in Barron's in like May through June of 1939. And I'm gonna start out with a recap, and then I'm gonna read starting from chapter 4. I highly encourage, if you haven't seen it already, I released a previous video on the first 3 chapters of this book. But I'm going to be recapping the core ideas and then starting from chapter 4. So the foreword. About 15 years ago, an investment philosophy was developed which became very popular in the pre-Depression days. This philosophy was based on the premise that American industry had a long period of substantial growth ahead of it. As a result, the argument ran, the conservative investor could safely share in the industrial growth of his country by holding common stocks, specifically the shares of leading corporations. So I'm almost certain the philosophy that he is referring to was popularized by Edgar Lawrence Smith in his book Common Stocks as Long-Term Investments. This book was also interestingly mentioned and referred to both in writing and verbally by Warren Buffett in his shareholder publications, trying to tell people his philosophy is centered around buying broadly, holding for a long period of time. This book argues pretty conclusively with mathematical examples that doing that is pretty likely to result in decent results for most people. So in this book, for instance, during the 1920s, early to, up to the end of the 1920s, that, even if you bought with the worst timing, and you bought broadly with no other selection criteria other than just volume of trading by shares, that it would, by buying broadly, you spread out your risk, but not your, growth amount. And that might be a good philosophy for long-term investments, rather than viewing the market as extremely like speculative, like a roulette wheel. So his argument was buying broadly, waiting for a long period of time, more than likely than not going to work out well for you. And that was very interesting at the time, because before this popularized the idea of like mutual funds, most people saw the stock market as like not a thing that normal people put savings into, but they thought of it as like a gamble. You were gambling on the success of whatever companies. But his argument was, no, that's not so. And the reason is, he argued, that productive enterprises have an element akin to compound interest, where they reinvest in their productive potential. So breaking that down, that means that he argued that as a shareholder, you own a part of a company, a business, and that business, it may so let's say it throws off some money as dividends to the shareholders. That's nice, that's good. People love dividends, but it also, most companies don't spend all of their money immediately. They'll reinvest some of it into their productive potential, say like buying new equipment, hiring staff, investing in training, and that this property of reinvestment is a property akin to compound interest, and that by buying common stocks, you are buying into this property of compound interest almost, and that over a long period of time, that will likely be work in your favor. So that's the thesis of this book. This book is saying that, back in, the 1800s up to 1929, you could have invested in whatever the heck you wanted. Industrial growth was so strong in the United States that that was likely to work out for you. But he's saying that, in the years since the 1929 bubble burst, some companies have done better than others, and he wants to know why that is, and he wants to build a philosophy based off of that. So he says, to investors with a long-range point of view, the selection of securities in growing industries and companies is extremely important. But the difficulties of achieving such a selection have become increasingly great as the growth of the industry in general has slowed down. The author of this study began to work out a theory of investment based on a recognition of the fact that corporations have life cycles similar to that of humans nearly 10 years ago. So starting in 1929. Since 1934, he has tested the soundness of his theory by applying it to an actual fund. The results of this investment experience are strong evidence that the restriction of one's investments to growth stocks is sound in practice as well as in theory. So the name T. Rowe Price probably has some name recognition, huge in the investing world still. They famously donate to public radio and PBS and stuff like that, if you happen to have the name catch your ear. I'm not affiliated with them. This is just a book that I'm reading from them. So corporations, like people, have life cycles. Risks increase when maturity is reached. That's one of the first arguments this book makes. So he says at the time in 39, railroads and automobiles, for instance, might be considered matured companies, and that investing in them is a little bit more of a risk because they might already be matured. Whereas chapter 3 had a very a good amount of interesting examples he examined, where his argument was an investing philosophy that takes secular trends into account, and picking companies that are still in their growth phase, and that are not fully matured companies, that it might be a sound investment strategy. So one of the examples he gives, which is really interesting, is airplane production, which in the period before World War II, when rearmament was happening and airplanes were becoming more common in the US, people were having more demand for air freight. Airplane production, if we look at it, before 1939, 10 years before, has a very clear growth trend, whereas automobile production, for instance, could be considered as a matured industry. And then he goes on. I really like this example that he gives of the increase in molybdenum shipments, a mineral required for the alloying of metals, and base nickel and steel, which he considered as already matured industries. So famously, rearmament was happening during this period. The building of weapons and such before World War II. Metal alloying was a technology that was relatively new. It was becoming much more common, and it was a very important technology. I believe in World War II, for instance, the ability to use steel alloys in the production of cast tank turrets allowed them to be bigger, and while weighing less and having the same strength, which for tanks was very important, for instance, but it was used in all kinds of other things, these metal alloys, for various properties that are important for industrial use. And so as a result, the industries which produce this mineral necessary for this production had a much more profound growth than the already matured industries. And he looks at the prices, he looks at the raw data in terms of the shipments of it. It's really interesting. It's a really interesting philosophy. It's not quite as empirical as the one presented and demonstrated pretty conclusively and mathematically by Edgar Lawrence Smith in this book, but it is an interesting philosophy. So I'm going to be starting my reading from chapter 4, How to Detect the Change from Growth to Maturity, Chrysler versus General Motors. So this is going to be like an interesting set of case studies, and he's going to be looking at having kind of issued my point of this, that we're looking at the life cycle of companies. How do you know if it's in a growing phase? So I expect this to be interesting. So he says, detecting with a high degree of accuracy when the long-term earnings growth of a company has ceased is difficult because no mathematical formula can be applied to determine when the change from growth to maturity or decedence occurs. So he's saying it's not as clean cut as, for instance, Edgar Lawrence Smith's philosophies, but he's going to provide some qualitative information on how you evaluate these companies. So he says, there's no clear line of demarcation between the three phases because, one, the business cycle and a company's life cycle, which usually extends over several business cycles, run concurrently. So the business cycle is typically like periods of growth and then bookended by periods of like recession or depression or economic contraction. That's basically all he means by that. Two, those factors which adversely affect a company's secular earnings growth often assert themselves during a period of depression when earnings are low. So he says, you might not know whether a company is really doing well until times get hard. A cyclical decline in earnings due to a general business depression may be wrongly interpreted as the end of secular growth. Likewise, a cyclical recovery in earnings may be mistaken for a continuation or resumption of secular growth. So that's why he says there's not as much of a clean-cut mathematical definition for what constitutes a growth company, because he says the factors influencing it are very volatile. Aside from the general business cycle, which affects almost all businesses, some industries, such as real estate and oil, have their own cycles of prosperity and decline. The real estate cycle usually requires about 18 years for completion, while the oil industry is influenced by the discovery of new flush fields, which cause overproduction and depress prices for oil and gasoline. So famously, in the oil cycle, there's been like a shale oil boom in the US and then a shale oil bust due to OPEC lowering, the OPEC cartel lowering its prices. So, a lot of these things still happen today. In attempting to determine the position of a particular company in its period of growth or decline, not only must the business cycle and the cycle of that company's industry be considered, but also many factors which may affect the secular trend of the company in varying degrees must be taken into account. Not all the companies of a certain industry may be affected by the same factors, and certainly not all to the same degree. Or extent, he uses the word extent. Sound judgment is required to appraise the relative importance of these other influences on each company. So he gives 10 considerations. I think good foresight is demonstrated in these 10 considerations, which, is probably way ahead of its time for 1939. We think of these things a lot nowadays with the role that technology plays in our lives. But it's interesting to see that they're considered in such great detail and of such importance even back then. So his 10 factors are: 1, change in management; 2, saturation of markets; 3, new inventions; 4, expiration of patents; 5, increased competition; 6, adverse legislation; 7, unfavorable court decisions; 8, sharp rise in the cost of materials; 9, sharp rise in labor costs; and 10, an increase in taxes. So he says, in some instances, one factor, such as adverse legislation or expiration of patents, may be wholly responsible for the changes in secular earnings trends. In other instances, a combination of factors may be the cause. The results can be measured by a study of the trends in 1. Sales, 2. Profit margin, and 3. Return on invested capital. Interrupted growth in the utilities industry. The power and light industry is an excellent illustration of how numerous adverse factors occurring during a depression can check the secular earnings growth of the companies whose common stocks appeared to qualify as growth stocks prior to the depression. Companies in this industry possessed a strong secular earnings growth in 1929, and for many months after the depression started, net earnings continued to increase, reaching up to new high levels in 1930 and showing only a slight decline in 1931. Up until the advent of the New Deal in 1933, which was after the lows of the Depression had been reached, it was a reasonable expectation that the earnings of the power and light industry would recover up to new high levels during a subsequent period of prosperity because of the favorable outlook for growth in electric power production. However, government competition, persistent and successful efforts to lower rates, and a sharp rise in taxes reduced the industry's profit margin. It was not until January 1938 that further developments, including 1. An adverse decision by the Supreme Court, 2. The failure of the government to compromise in the fight with the utility industry, and 3. A new business recession accompanied by an increase in inflationary measures, led to the decision to remove the power and light stocks from the growth list. It will probably be several years before it can be established whether or not the end of secular growth in earnings has occurred. So contrast in 2 companies. While most of the companies in this industry have failed so far to recover their former high earnings, the Pennsylvania Water and Power Company has been an exception and affords an interesting comparison with Consolidated Edison Company of New York, which has been subjected to a number of adverse factors referred to above. Earnings a share and the return on invested capital of these 2 companies since 1926 are shown in chart 1. So we can see Pennsylvania Water and Power, does hold steady or does pretty well over time. Edison in New York must have been, we can maybe speculate that they were very adversely affected by some of these conditions mentioned here. There were a number of factors in the spring of 1933 that indicated a change in the secular earnings growth of the Consolidated Edison. With the advent of the New Deal and its antagonism towards the light and power industries, this company was believed to be in a very vulnerable position. Its management was not progressive in its public relations, electric and gas rates were high, depreciation charges were low, and higher costs of material and labor and higher taxes seemed inevitable. While steps have been taken during subsequent years to correct some of these adverse factors, the 7.7% return on investment capital for the year 1930 has declined to 4.2% in 1938, and it is doubtful whether the company will be able to exceed previous peak earnings in the discernible future in view of the difficulty of increasing its rates sufficiently to offset the probable further rise in costs and taxes. The high return costs on invested capital, which has enabled the Pennsylvania Water and Power Company to make such a creditable showing, may prove to be unfavorable for the company in the years ahead, as recent Supreme Court decisions make it vulnerable to a reduction in rates, which would result in a decline in earnings per share. Advent of competition. Continental Can Company illustrates how adverse legislation and increased competition can check the earnings growth of a well-managed company in an industry which is still growing in volume of sales. This stock was classified as a growth stock until the middle of 1936, when it became apparent that the passage of the Robinson-Patman Act and the entry of Crown Cork and Seal and Owens Illinois glass companies into the tin can business would likely reduce the profit margins and possibly prevent the company from continuing its favorable secular earnings growth. So if we look at table 1, he says if you look at the net sales and you look at the profit margin, all that's been growing. Actually, the net sales hasn't been growing, but the profit margin has. The earnings a share was growing. He said even though it's growing, that may not be the case forever. So during the 5 years, 1925 to 1929 inclusive, Continental Can's earnings averaged $2.91 a share, and the dividends averaged $1.67 a share. The next 5 years, 1930 to 1934 inclusive, notwithstanding the Depression, were almost as good. Earnings have averaged $2.86 and dividends $1.65 a share. By 1934, earnings of $4.02 succeeded the previous high earnings in 1925 of $3.59, thus confirming in the belief that Continental Can was still a growth company. Although general business continued to improve during 1936 and 1937, earnings for the above company declined, as shown in Table 1, indicating that the secular growth had ceased. The figures in the table measure the results of adverse legislation and competition. Although invested capital increased 40%, sales were only 26% higher, while profit margin declined 44%, and earnings a share 46%. While it is possible that at some time in the future this company may be able to overcome the adverse factors which interrupted secular growth, the uncertainties appear sufficient to disqualify it as a growth stock, at least for the present. So Chrysler versus General Motors. This is the chapter title. A comparison of Chrysler Corporation with General Motors Corporation illustrates the importance of trying to detect the end of secular earnings growth, of measuring both growth in the volume of sales and the trend in return on invested capital. While the trend in profit margins is one of the most important factors considered, it is not always the company which reports the higher profit margin that proves to be a better growth stock. Sometimes a company which has relatively low profit margin is able to greatly increase its sales volume without increasing its capital investment, and thereby increase its earnings per share. The growth of the automobile industry appeared to be reaching maturity in the late 20s, yet two of the leading companies continue to grow by increasing their share of the total production of the industry, as shown in Table 2. So he said the automobile, you could think of it as like one of these already matured decedent industries. But if we look at this chart, showing the General Motors, and this is I don't like this. They have the years backwards here. But we see as time goes on, Chrysler and General Motors were, starting from a fifth roughly of the production of automobiles in the US to like 63% of all automobile production in the US, which is a huge, drastic change, even for an industry that was reaching maturation. So in 1934, both General Motors and Chrysler were on the growth stocks list, as it was believed, it may not actually be, that both companies would be able to report new high earnings a share during the recovery period. The trend in sales, profit margins, and return on investment capital for the two companies are compared in Chart 2 and Chart 3. Chrysler's dollar sales were growing at a faster rate than General Motors, amounting to $517 million in 1935 and exceeding the previous high level of $375 million reported in 1929. By 1936, sales had reached $667 million, an increase over 1929 of 78%. The profit margin of 11% in 1936 compared favorably with 10.8% in 1928. Earnings a share had reached a new high level of $14.25. And so this table is really interesting. As compared with the pre-depression peak of $6.80 a share, thus confirming the belief that Chrysler was still a growth stock. So we're going to unpack whether or not it actually was a growth stock. Motors had a higher profit margin. General Motors Corporation dollar sales of $1,439 million in 1936 likewise recovered sharply from the Depression, but were 4.4% lower than in 1929. While the company's profit margin of 19.7% in 1936 was slightly lower than the 21.1% reported in 1928, it was materially higher than the 11% for Chrysler. Earnings of $5.35 a share in 1936 failed to reach the previous high level of $6.05 a share reported in 1928. During the period 1928 to 1936, General Motors retained part of its earnings in the business. So this is referring quite interestingly to the concepts that we examined earlier in Edgar Lawrence Smith's book, Common Stocks as Long-Term Investments. The idea that a productive enterprise will not immediately use all the capital it accumulates. It will reinvest some of that capital back into its productive potential. And in an effect which resembles the same effects as compound interest, thus increasing invested capital by approximately 22%, while Chrysler reduced its invested capital by 20%. The charts show that while the General Motors profit margin was higher than Chrysler's and fairly well maintained, the return on investment capital declined 27% from 1928 to 1936, while the return on Chrysler's invested capital increased 53%. Earnings a share in the case of General Motors Corporation. So let's look at a chart. So basically he was saying Chrysler cheaped out on how much it reinvested, which, that's interesting to think for such a complicated industrial company like that. But the benefit for them was their let's see, their return on invested capital was much higher than General Motors. So this is like something that investors will sometimes try to like really, really optimize. So I think this is interesting, and we're going to probably unpack this further and see what the consequences were. So General Motors declined 11.6%. Earnings a share in the case of Chrysler increased 110%. As recovery progressed, it appeared that the General Motors earnings growth was fast reaching maturity. In January 1937, it became evident that General Motors labor would be unionized, with a resulting increase in labor costs. Because the growth in earnings appeared to be reaching maturity prior to this event, it was concluded that higher labor costs would prevent General Motors from qualifying as a growth stock, and it was therefore removed from the list. Chart 4, Matheson Alkali Works Incorporated, looking at in millions of dollars the invested capital, the return on invested capital, which is a very important metric, and then the earnings per share on their common stock, their equity. So Chrysler was also handicapped by unionization of labor, But because it still possessed more favorable prospects for growth in sales volume, it was retained on the list of growth stocks. If increasing capital investment does not increase the profits, a decline in the return on investment capital results. This declining trend is a warning signal. The chart on Matheson Alkali Works Incorporated, chart 4. So here, so this chart is showing an inverse correlation for this company, this specific company, on their invested capital that they put back into the business and the return on invested capital. So while their expenses shot up, their inability to, have their productive potential increased by this invested capital necessitated that, per dollar invested, their return on it was actually lower than it might have been previously, just because they weren't spending money wisely, let's say. So the chart on Matheson Alkali Works Incorporated is presented as an illustration of the importance of detecting diminishing return on invested capital. The company produces basic chemicals such as soda ash, caustic soda, chlorine, and allied products, and serves consumer goods industries. Since Matheson does not make a practice of publishing its dollar sales, it has been impossible to study the trend in profit margins. Earnings experienced a substantial growth during the 1920s, and the return on investment capital was at a satisfactory level. Although earnings and the return on invested capital declined during the following depression, early in 1934, the stock of this company was considered for the growth stock list due to the possibility that the earnings growth would be resumed and the return on invested capital would recover. However, the company had just increased its capital stock 33.33% to provide funds for the construction of a large plant in Louisiana. Two competitors were likewise constructing plants in the South. A study of the capacity of the industry indicated that the additional capacity was not necessary, and Matheson was believed to have invested this additional capital as a defensive measure to protect its markets in an area where it had previously enjoyed a freight advantage. Under the circumstances, an improved return on invested capital and earnings per share were not expected, and the stock was not included in the list. The average return on invested capital. So when he says lists, I'm pretty sure this is T. Rowe Price referring to like his personal list. So this overcapacity in the competition was probably one of these 10, which was enough for him personally to not put the company in his portfolio, and probably got it on his hit list, or preface that by a S if you so prefer. So he said, he continues, my green screen is messing up, look at this. Okay. The above cases are cited from so under the circumstances, an improved return on invested capital and earnings per share were not expected, and the stock was not included in the list. The average return on invested capital in recent years has been under 6% and is not commensurate with the risks involved in placing equity money in a company which seems to have reached maturity. So this is interesting. I'm trying to analyze what he says here. I don't know that I quite understand it. So it's still growing, but what he's trying to say is it's technically like it may or may not be a growth company, but regardless, the industry has not matured, which is the main thesis of T. Rowe Price's book here, is whether or not the life cycle of the company has matured. So I'll be interested to say what he says about that, given that even though there's competition, which is one of his 10 factors he looks at, it's not a matured company. So the above cases are cited from actual experience and are intended to help the investor detect changes in secular earnings trends in time to withdraw his funds from an investment before the decedent earnings trend becomes so obvious that the market has discounted the changed value. A lot of investors wouldn't agree with this. There's something that's been popularized recently called the efficient market hypothesis, which hypothesizes that all relevant information is already priced in to the share price of a thing. You may think that you're incredibly smart, but most of the time you're not really as smart as you think you are, like me. And other people have already priced anything in that you'd have heard about or interested, unless you're an insider, which is why a lot of times insider trading is illegal, or comes with a bunch of restrictions. I'm not sure if I'm as gung-ho about the efficient market hypothesis as some people are. I think there's always going to be an element of crowdthink, psychology, popular trends, etc., that influence how people behave, and does not result in an efficient market. But that's not a mainstream opinion, and that's not empirically as backed up as the reverse of it is. So you have to be careful with this, what T. Rowe Price is saying here. Basically, all this boils down to is I'm saying be careful with this idea here. Just be careful with it. The causes of the change can often be detected before the results can be measured in terms of sales, profit margins, and return on invested capital. Yeah, I would say, especially with the internet, this might be more difficult than he's claiming here. He might think he's one of these hotshot guys. So the following list of stocks includes all the stocks which were held as probable growth stocks during the 5-year period 1934 through 1939. They have been divided into 3 groups. 1, those which have already proved to be growth stocks because subsequent earnings per share have exceeded previous maximum earnings per share. 2, those stocks which are expected to reach new high earnings at a later time when it is anticipated that business for the respective industries will be more profitable. And 3, those stocks which have been withdrawn because subsequent events have indicated that maximum earnings have already been reached. So what's he saying here? Let's see if I don't think I understand this. Yeah, so he's saying just the growth alone is not like going to prove whether or not they're a growth stock. He has 3 criteria, or 3 groups that he divides them in. So the first one is those proven to be growth stocks because their earnings per share have exceeded previous maximum earnings per share. The second group is those stocks which are expected that profitability will increase and more growth will occur. So the second is like expected increased profitability. And the third group is stocks which were withdrawn because let's say T. Rowe Price wasn't happy with the earnings trends. He thinks that a maximum has already been reached. So group 1. Okay, so proved to be growth stocks because subsequent earnings a share have exceeded previous maximum earnings per share. So this will be an interesting exercise. This book was written in 1939, so let's say 80 years ago from today. Let's see how many of these names we recognize. Chrysler, Climax Molynubium, Coca-Cola. Buffett is a big fan of Coca-Cola. Curtis Wright, Douglas Aircraft, Dow Chemical, Dr. Pepper. I'm a big Dr. Pepper fan. DuPont, which is a chemical company. Fidelity and Deposit. International Business Machines, IBM, computers. Well, they would later do computers. Right now, they were making machines to help the Germans with the Holocaust. But that's another story. International Nickel, Masonite, Honeywell, Monsanto Chemical, responsible for poisoning all of us. J.C. Penney, Procter and Gamble, Sherwin-Williams, Standard Oil of New Jersey. So this was probably one of the parts of Standard Oil that got broken up. United Aircraft, which he had talked about earlier. So group 2, those stocks which are expected to reach new high earnings at a later time when it is anticipated that business for the respective industries will be more profitable. Let's see if we recognize any of these. Black & Decker, General American Transportation, General Electric, Remington Rand, and Sears Roebuck. So Sears Roebuck was anticipated to be more profitable over time. So like say they're like Amazon of the day. They might have had increased efficiencies as they were more centralized. Railroads were making things, you know, previously railroads were making time and space shorter. The Sears catalog used to be like a huge mail order catalog, and that was basically their Amazon of the day. You know, it changed a lot of people's lives. Like I think you could order a house on a rail car, like on the Sears Roebuck catalog. You could like build your own house kit that came with like a bunch of different stuff, and you can actually see some of those still around that were built from those mail order things. Standard Oil of California, Technicolor, United Airlines, Fidelity, Westinghouse. So a lot of those names are recognizable in the second group, where it was anticipated that their profitability would be increasing. And then group 3 is those stocks which have been withdrawn because subsequent events have indicated that maximum earnings may have already been reached. So let's say the earnings are declining. Let's see how many of these companies we recognize. American Tobacco, Caterpillar, Deere and Company, that's interesting. Detroit Edison, General Motors, really, General Motors even at that time. Pacific Gas and Electric, Pacific Lighting, Reynolds Tobacco, and then like some gas companies and other weird companies. So not a lot of recognizable names 80 years later here. The recovery period, 1936 through 37, was unbalanced and was not an adequate test for all industries. The building and construction industry, for example, recovered to less than 50% of its pre-depression level, and building companies, as a group, have not had an opportunity to develop their maximum earning power. General American Transportation Corporation and the railroad equipment industry appears to be a company which might well attain new high earnings when railroads materially increase their expenditures for equipment in order to handle increased freight during a period of prosperity for the construction industry. So this is an interesting idea. So maybe we could postulate that the construction and railroad industries were co-secular. Electrical equipments represent a third group which should develop new high earnings when the power and light industry increases deferred expenditures for new generating facilities. Certain producing oils and coppers are retained as growth stocks because it is believed that inflation will enable these companies to report higher earnings a share during the recent recovery period. So this last sentence is interesting. Some people might feel this way about mining and commodities and like gold mining stocks, for instance, and put them in the growth stock category, oils and coppers. So he's referring to like oil companies and mining as a inflation hedge. or not a hedge, but it's believed that inflation will dilute their operating costs and allow them to have higher earnings a share. That's believed at that time. This is not investment advice, but I think that perspective from 80 years ago is really interesting. Yeah, at a time where they were going to start having inflation. But this was like pre-war, and there's a whole bunch of other stuff that, is important to consider. So that was chapter 4. I think it's interesting that he came up with a couple different groups. His 10 criteria, let's just kind of read back through them, were a change in management. So like right now you might think like the Intel Corporation has changed their CEO to this guy who like was an engineer and did the 386 processor. He was the chief architect of the 386 processor, and like I think a lifer in the company, and he's the new CEO. So like that would maybe saturation of markets. So they gave the example of the chemical company where there was a productive overcapacity that resulted in a saturated market. 3 new inventions, 4 expiration, so a better mousetrap, 4 expiration of patents. Like a couple of years ago now, the patent on the MP3 audio compression expired. So that might have been a huge trend, changing how media was consumed, let's say. So if you were the company that held the patent on MP3, that might have affected you greatly. 5, increased competition. That doesn't need to be said. 6, adverse legislation. He gave the example of utility companies, unfavorable court decisions. Companies fight in court all the time. Sometimes they fight with the taxing authority, for instance. 8, sharp rise in the cost of materials. 9, sharp rise in labor costs, such as like unionization, whatever. Amazon is currently trying to fight unionization like everywhere, and that might be why they fight so hard and so dirty. 10, an increase in taxes. So taxes aren't fun, but it's not fun to go ham on them either. So yeah, that was chapter 4. So I think he's going to be talking kind of similar to Edgar Lawrence Smith about, diversification and being like flexible. So he's probably going to say something about trying to reduce volatility by balancing different types of companies, I'm guessing. But I'm going to pause here for now. I'm going to check on the quality of this stream. And then if it's good, if I'm happy with the technical setup, I will probably start and then finish reading chapter 5 for today. So